risk management framework is vital to an enterprise. If we ask the question, why Arthur Andersen failed and was terminated as a business, it goes back to the point where the accounting firm shredded audit documents that obstructed justice. But that led from that is that the firm was under felony, and any firm that's under felony can't conduct audits, and they had to surrender their CPA license. But this event of Enron and corporate collapses in general highlighted some of the major events and actions taken in relation to internal controls. The first one is the Sarbanes-Oxley Act. This act, the main purpose of this act is to protect investors from fraudulent accounting. The second is the PCAOB, Public Company Accounting Oversight Board, that originated from the Sarbanes-Oxley Act, and the PCAOB is an oversight body that was formed to regulate auditors of public traded companies. The third is the Committee of Sponsoring Organizations, and they were vested with the responsibility of developing an internal control framework. Fourth is the Securities Exchange Commission, and they have a mandate for the effectiveness of internal controls over financial reporting using a suitable framework using the definition of internal control, and they recommended the COSO or the COSO framework that was developed by the COSO body. The key provisions of the Sarbanes-Oxley Act, which is to enhance the quality of financial reporting, created a new accounting oversight board, the PCAOB, strengthened the audit independence rules. For example, an external auditor that's auditing an entity cannot provide consulting services to that entity. Third is to increase accountability of company officers and directors. That leads to true and fair view of financial reporting. Fourth is to mandate upper management to take responsibility for company's internal control structure. Fifth is to combat white-collar crime with more severe penalties. The PCAOB auditing standard number 5 require that the management of each audited or publicly listed firm evaluate the design of entities' controls to determine whether they are adequately addressing the risk that are materially misstated in financial statements. Second is to gather and evaluate evidence about operations of its controls. Third, it also has the responsibility of aligning the nature and extent of evidence with assessment of the risk associated with those controls. Fourth, it must present a written assessment of the effectiveness of internal controls or financial reporting. Fifth is, as part of annual audit, the independent auditor must test and report on the effectiveness of company's system of internal controls. The COSO, Committee of Sponsoring Organizations framework, has 5 sponsoring organizations: the American Institute of CPAs, Institute of Management Accountants, American Accounting Association, the Institute of Internal Auditors, and Financial Executives International. On 27 June 2007, the Securities Exchange Commission issued a revised guidance that's relating to the management's implementation of the Sarbanes-Oxley Act, Section 404.15. This ruling states that the management assesses the effectiveness of internal controls or financial reporting using a suitable framework that contains the definition of internal control, and suggested the COSO framework. Let's look at a risk management framework. The Committee of Sponsoring Organization, COSO, put forward a risk management framework where it considers internal control is a process effected by the enterprise's board of directors, management, and other personnel to provide reasonable assurance regarding achieving objectives in 4 categories. The first one is the effectiveness, that is, to the degree to which an enterprise accomplishes its objectives. Second is about efficiency, that is, the ability of an enterprise to accomplish objectives with minimal waste of resources. Third is about reliability of financial reporting. And fourth is about compliance with applicable laws and regulations. There are 5 components of COSO internal framework. The first one is the control environment. Second is the risk assessment. Third relates to control activities. Fourth, about information and communication. Fifth, about monitoring. So let's now look at the COSO framework, these interrelated 5 components. The control environment. It's influencing the control consciousness of its people. Second is the risk assessment. It's about identifying and analyzing relevant risk to achieve enterprise's objective and form a basis for determining how risk should be managed. Third is about control activities. It's controlling activities through policies and procedures to ensure that the management directives are carried out. Fourth is to inform and communicate to identify, capture, and exchange information in a form and timely framework that enables people to carry out their responsibilities. Fifth is about monitoring, a process that assesses the quality of internal control performance over time. This is a key element in the long-term success of an internal control framework. So let's look at one by one now. These components, the control environment. The control environment, enforcing the control environment through internal control, is enforcing the integrity and ethical values, commit to competence, use the board of directors and audit committees to oversee the policies and procedures, support management's philosophy and operating style, create an appropriate organizational structure, assign authority and responsibility accordingly, use human resources policies and procedures that are consistent with organizational objective. Second is about managing risk, assessing risk. First is to create company-wide objectives of risk assessment. Second is to create process-level objectives of risk assessment. Third is to identify and analyze risk. And fourth is to manage change in relation to risk assessment. The third component is about control activities. In controlling risk, the enterprise must follow policies and procedures that are enacted in that enterprise and keep improving security in relation to application and network, conduct application change management, and plan for enterprise continuity and backups. Fourth is about information and communication. Enterprise must measure information quality, measure effective communication consistently. Fifth is about monitoring. Is to undertake ongoing monitoring and to conduct separate evaluations.